Hi, I'm Brian Pascoe, and as the new CEO of ICMA, I'm honoured to be opening my first general meeting of the ICMA Repo and Collateral Council. It's unfortunate that once again we are doing this in virtual format, but I hope that it's not too long before we can once again meet in person. Repo and collateral are at the very heart of capital markets, and it is therefore no surprise that the ERCC is one of ICMA's key constituencies and a fundamental pillar of ICMA's work. I think that today's agenda and the supplementary online briefings highlight the diversity and depth of the ERCC's various work streams and initiatives, guided and driven by the membership, particularly through a dedicated and dynamic ERCC committee under the adept chairmanship of Gareth Allen. And I would briefly like to touch on just some of the key themes central to the ERCC agenda. To coincide with this general meeting, ICMA is previewing its 41st semi-annual European Repo Survey. For more than 20 years, the ERCC survey has been the primary source of European market data, highlighting trends and shifts in market structure and providing invaluable insights for market practitioners, regulators, and other stakeholders. It is testament to the value of the ERCC survey that even in the wake of regulatory reporting initiatives, such as SFTR, it remains the primary window into the European repo markets. Technology is a cross-cutting theme for all of ICMA's work, and none more so than repo and collateral. In the past months, ICMA has completed the first phase of its initiative to extend the common domain model to include repo transactions. The CDM is seen as a vital component of ICMA's commitment to standardized digital and data representation to augment existing processes and underpin future market development. As the cost of regulation mounts and as margins are squeezed ever tighter, we are seeing increased focus on driving efficiencies and minimizing waste. This is no more visible than in the case of settlement processes. The introduction of settlement discipline measures under CSD regulation, including cash penalties and the spectre of mandatory buy-ins, have only helped focus the attention on the need for settlement efficiency. And while a reprieve of the mandatory buy-in regime looks increasingly likely, the drive to streamline post-trade processes and to create a framework for market best practice around this remain critical. And here the ERCC is leading the industry with a number of initiatives. We will hear more about these in the second panel. These days, it is difficult to have any conversation on bond markets without wandering onto the topic of sustainability. More recently, this has also become the case for repo and collateral. As many of you will know, sustainable finance is another key pillar of ICMA's work, and ICMA has been a market leader in supporting the development of the green and social bond market. Earlier this year, the ERCC published a consultation paper exploring the role of repo in sustainable finance. This is the topic of our first panel today, and while the discussion is still at its very early stage, there is an important role for the ERCC to play in shaping the conversation. Before we move on to today's agenda, I wanted to take a few brief moments to say some thank yous. Firstly, our gratitude to Piro, our hosts for this event. I would also like to thank today's speakers and panelists, in particular Torsti Silvonen, Deputy Director General, DG Market Operations at the ECB, who kindly accepted our invitation to provide the keynote address. Also, the ERCC Chair, Gareth Allen, and Vice Chair, Emma Cooper, as well as the other committee members. But mostly, I would like to thank you, the members of the European Repo and Collateral Council, who provide the direction, vision, and energy that underpins all of our work. I would now like to hand over to Phil Morgan, CEO of Piro.
Good afternoon. It's a privilege for Piro to be opening today's event. My name is Phil Morgan, and I'm CEO at Piro, where I've been for 5 years after spending over 20 years as a market practitioner in various security finance roles. Piro has been a member of ICMA for over 2 years, and many of our clients are represented here today. However, it is possible that we're not universally known, so please allow me to give you a brief summary of our activities. Piro has been providing post-trade services to the security finance industry for over 21 years. In our position as an independent and trusted provider, we enjoy working with the market and are committed to delivering automation across all elements of collateralized activity. To give you a sense of our scale, Piro processed 2 million repo and stock loan transactions a day, with a notional value of $3.5 trillion. And indeed, we support the world's largest financial institutions. As a service provider, it's imperative for us to solve industry problems as robustly and efficiently as possible. A recent example of this was our SFTR reg reporting solution, which we delivered in collaboration with IHS Markit for over 200 of our clients and support their daily reg reporting activities ongoing. In recent years, we have also expanded our collateral management services to provide enterprise-wide visibility, analytics, and mobilization across repo, stock loan, and derivatives. By using our Collateral Connect product, clients optimize their collateral usage and improve management of finite financial resources, as well as maintaining ESG compliance. CSDR is the latest regulation to dominate the thoughts of many, and we'll be hearing about it in this afternoon's panel. Ahead of the February go live, Piro have recently launched the Trade Risk Manager tool to assist front office improve trading efficiency and fails management, as we strongly believe at Piro that prevention is the best way to manage CSDR. Finally, before letting the conference get into full swing, I just wanted to talk about an exciting product that we're due to launch in January 22, and one that is repo specific and we call Repo Connect. Nick Barnes and Scott Brown from the Piro team have been working with many of you closely to develop this best-in-class automation of affirmations and pair-offs, as well as all the associated lifecycle events in repo. Repo Connect builds on our long-standing post-trade repo and bond borrow product and offers exceptional automation. If you'd like to learn more, then please give me a shout, or indeed anyone from the Piro team. So with that, I thank you for your time and the opportunity to speak. And we wish the whole ICMA team the best of luck with today's event and thank them all for what they do in our industry. So thank you and have a fantastic afternoon.
Hello, everyone. And thank you, Phil and Piro, for kindly hosting today's 2021 General Meeting for ICMA's European Repo and Collateral Committee. Also, I'd like to warmly welcome Brian to the ICMA community. We're very excited to have you on board to help us leading ICMA in its objectives. ICMA is an extremely important trade association to its members, bringing together participants to discuss issues, set rules, and make recommendations to members. Brian's vast experience in capital markets in the industry brings a huge vault of knowledge to the organisation to continue in its success. So welcome, Brian. So as we charge headlong towards the end of 2021, I wanted to just take a moment to reflect. We've seen the pandemic continue to stress all aspects of people's lives and test the resilience of many industries globally. We've seen sustainability and the impact of climate change on the planet more in people's minds than ever. And it also feels to me that the market has been nervous, waiting, wondering, trying to guess when central bank intervention may or may not start to ease. This led us to put together a very interesting and topical agenda today, touching on sustainability, central bank policy, and also the upcoming implementation of CSDR and its impact in our markets. So without further ado, I'd like to welcome today our keynote speaker, Torsti Silvonen, who is the Deputy Director of the Directorate General Market Operations at the ECB. His responsibilities include the ECB's activities in the area of FX markets, foreign reserve management, ECB's own funds and pension fund investments, as well as planning, coordination, and execution of the ECB's asset purchase programs. He was also one of the co-chairs for the climate change workstream for the ECB's strategy review and leads climate change work in the ECB's market operations area. Thank you, Torsti, for taking the time to speak to our market today.
Hello all, and many thanks for the invitation to speak at your general meeting today. I was told that you will discuss the role of repo in sustainable finance, as well as your own role. And I was asked to reflect on climate change and our role based on recent ECB strategy review, which was published this summer. Now, climate change is a hot topic, literally. There are increasing number of news of climate change events around the world, and the news is not good. There are also increasing number of studies of future scenarios, including the results of the ECB's economy-wide climate stress test from last week. The news there is not good either. This puts us all to think about our roles with climate change. We've done our share of soul searching, which I would explain to you in 3 parts today. I will first give background why we think climate change is relevant for us and why we have to take it explicitly into account from now on. I will then explain what is the logic of our published marching order. And third, I will explain what is our action plan, including also considerations concerning collateral, which is particularly close to your group. As regards central bank's role, the very first speech by ECB on monetary policy and climate change was given by Benoit Cœuré, whom many of you well know, exactly 3 years ago. At that time, the topic was only entering the central bank policy field. Regarding the central bank role, also Benoit confessed that views and opinions certainly differ, but he argued that the ECB, acting within its mandate, can and should actively support the transition to a low carbon economy in two main ways. First, by helping to define the rules of the game, and second, by acting accordingly without prejudice to price stability. Since then, certainly a lot more discussion has taken place. Our president, Madame Lagarde, emphasized in January that clearly central banks are not the main actors when it comes to preventing global heating, as governments have the primary role with environmental policies. But the fact that we are not in the driving seat does not mean that we can simply ignore climate change or that we do not play a role in combating it. We face the same physical and transition risks as everyone else, and we need to take them into account and reflect in our policy framework. This is not a mission creep, it simply is acknowledging reality. The outcome of the ECB strategy review confirmed these statements and was even clearer in two respects, which you can see in slide 2. First, climate change and green transition impact macroeconomic indicators such as inflation and growth, in broader terms, finance stability, and the transmission of monetary policy, thereby impacting the price stability outlook. Second, with EU transition policies, climate change affects the value and risk profile of assets on the Eurosystem balance sheet, thereby leading to a greater climate-related financial risk, which we, like everyone, need to manage. To put it simply, we need to take climate change into account to fulfill our primary objective and to minimize the risks for our balance sheet. So this is not an option, but a requirement for a central bank whose primary objective is price stability in order to fulfill its mandate and comply with EU law. The timing to clarify our role in this field was opportune now that we reviewed our strategy for the first time in 20 years. Meanwhile, also EU Green Deal and sustainable finance agenda have become a policy priority for the EU, and we have a secondary mandate to support general EU policies. All these reasons point out that we need to incorporate climate change related risks into our framework. The question is how? We have structured our work according to 3 milestones shown in slide 3. The overriding idea is to walk before run, with a determination to run rather soon. So first, we have started with paving the way with more relevant and reliable data. Second, we build and share knowledge with Eurosystem using that data. And third, once comfortable with both pillars, we move into action. As regards the first milestone, paving the way with reliable data, it is in our central bank DNA to conduct analysis with proper data. What we need now is good climate data to our models and make these models fit for climate change. And this is also linked to what Benoit meant 3 years ago with his point on helping to define the rules of the game. The EU Commission is responsible for the EU taxonomy and regulation, but we have actively contributed in technical groups to support their work. For example, supporting new CSRD regulation to create mandatory common reporting standards of sufficient quality that underpin comparable, transparent, and reliable sustainability-related disclosure. These are essential for developing more comparable and reliable sustainability metrics, the correct assessment of sustainability-related risks, and therefore the pricing of assets and calibration of risk control measures. Better data is a prerequisite for better analysis and better action. It's also important to be forward-looking, and therefore we have welcomed the inclusion of forward-looking targets in the new CSRD proposal. Our second milestone is to build knowledge around the bank and the entire Eurosystem. We want to learn by doing, and therefore we announced that we will check our own exposure to climate risks and also disclose climate-related metrics on the entire Eurosystem's non-monetary policy portfolios, which are our investment portfolios, but also on the CSPP policy portfolio within the next 1.5 years. At this moment, the Eurosystem is conducting a joint procurement tender for selecting data providers which are specialized in the analysis and provision of climate metrics, and which we will need to use for the purpose of our own disclosures. Additionally, our finance stability side will continue to work to regularly check firms and banks' exposures to climate risk from a macroprudential perspective, while the SSM, the supervisory arm of the ECB, is scaling up the work to integrate climate-related and environmental risks in their supervision of individual banks. Our own ECB risk management has already started to review how credit rating agencies and their credit ratings incorporate climate change. Once we have advanced on knowledge and data, we will move to the third milestone and define the way to include climate considerations concretely also into our collateral and asset purchase framework. So let me explain our action plan in more detail using the 6 concrete priority areas given by Governing Council, which are shown in slide 4. I have highlighted in darker blue the areas where financial market operations and risk management have a leading role. As mentioned, any climate change policy hinges on the availability of reliable statistical data. That is the first circle on the top left. The ECB can contribute to developing statistical indicators at granular and aggregated levels. We will first focus to develop by end 22 indicators on green financial instruments, construct indicators on exposures of financial institutions to physical risks through their portfolios, and derive indicators on the carbon footprint of portfolios of financial institutions. The idea is to develop statistical collections in 23-24 related to climate change. The second circle refers to macroeconomic modeling and scenario analysis. Our economics department has started to introduce technical assumptions on carbon pricing and will evaluate the impact of climate-related fiscal policies on the ECB's tough macroeconomic projections by the end of 22. From 22 to 25, our focus is to integrate climate risks into ECB models, assess impact on potential growth, and do scenario analysis on transition policies with an aim to model implications for monetary policy transmission. The third commitment is about disclosure. As a starting point, the availability of better data could underpin more harmonized climate-related disclosures. We will consider disclosure requirements for private sector assets as a new eligibility criterion or as a basis for differentiated treatment for collateral and asset purchases. When doing that, we will take into account EU policies and initiatives in the field of environmental sustainability disclosure and reporting, while maintaining proportionality through adjusted requirements for small and medium-sized enterprises. Parallel to the EU disclosure regulation, which enters into force in 2023, we will conduct legal and operational preparations with a view to act as a catalyst and support EU policies from our perspective. The fourth circle and commitment is to enhance our risk assessment capabilities. This includes 2 points. First, we will assess how credit rating agencies incorporate climate change in ratings and disclosures and consider developing minimum standards for our internal credit ratings. Depending on findings, we will potentially introduce climate change related requirements into Eurosystem credit assessment framework. Second, we are preparing data and methodology for climate stress tests of our Eurosystem balance sheet, and will conduct pilot climate stress tests next year. From 2023 onwards, we plan to introduce regular climate stress tests. Finally, the last 2 circles concern corporate asset purchases and collateral framework. As regards our corporate asset purchases, we have started to conduct enhanced due diligence to each of around 300 eligible CSPP issuers, and will develop this work further. As mentioned, we are also preparing climate change related disclosures for the CSPP portfolio. we will develop proposals to adapt CSPP framework to include climate change considerations by mid next year, but need further work, for example, on the following questions. What are the best data and metrics available now, and which of them may improve soon, as this is a very dynamic field? How to ensure adequate consistency and level playing field across issuers, or also how to best drive change and incentivize issuers to the right direction, and weigh all these different trade-offs. You see that this will require a lot more discussion. Last but not least, the collateral framework. We will study climate change consideration when reviewing the valuation and risk control frameworks, and depending on the findings, we will develop proposals accordingly. One current area of study is, for example, examining whether the theoretical collateral valuation methodology adequately considers pricing signals related to climate change risks. At the same time, we will continue monitoring green and sustainable financial innovation, as we did when we accepted sustainability-linked bonds as collateral and for our asset purchase programs from January this year onwards. We will assess our experience with our eligibility rules and procedures for SLBs to ensure that the rules adequately fill the intended specific environmental objectives while also mitigating the risk of greenwashing. And we also want to ensure that our procedures are clear to all market participants. So this is our roadmap and action plan for climate change. It leads me to my final point, which is very relevant to you as financial market participants. Climate change discussion is often dominated by dark painting of various risks, but the transition risk is not one-sided. As our president has said, yet the transition to carbon neutral is not so much a risk as an opportunity for the world to avoid the far more disruptive outcome that would eventually result from inaction. All our studies show that the sooner we all act, the lower the costs to mitigate climate change impact. From that perspective, all potentially promising action to support transition and green funding in financial markets should be explored in positive light. I found a number of interesting elements in your Green Repo survey. Repo is an important instrument to enhance market liquidity and market functioning, and any ideas to promote them seem well worthwhile to explore further. Have a great meeting and good luck with your discussions.
Welcome to the rest of the meeting, virtual and live. Welcome to Brian. I'm sure we as ERCC will have your support as much as we had it from Martin. Martin, stay well, stay in touch. Many thanks for all your work. Keep well. Thanks, Toto, for your insight. Important, we, the financial market, understand the collateral we use. Before kicking off the first panel, let me pause a little in memory of James Margeri, who passed away last week after a short illness. James was well known, very much engaged in our market, and always ready to listen and find solutions. He will be missed by all. My thoughts go to his family. Thank you, James. Rest in peace. As you may know, we had a consultation and created a wealth of, may I say, different insights on sustainable finance. This topic that will be discussed in the forthcoming panel will be interesting for us and for many in the markets. May we ask to put your questions to be posted online? Zan, the floor is yours.
Great, thanks, Gottfried. Hello, everyone. Good afternoon. Welcome to today's virtual event. My name is Jenchen, and I'm associate at ICMA, working closely with the European Repo and Collateral Council, focused on repo and sustainability. I'm delighted to be joined by a group of highly distinguished panelists to discuss this topic today. And before I introduce our speakers and open up the discussion, I just want to quickly say a few words and share some background on the work that we have been doing in the field. So ICMA's European Repo and Collateral Council, the ERCC, really recognized the growing importance of sustainable finance market and also actively considers the role of repo in this context. And as mentioned earlier, back in April, we published a consultation paper exploring the different possible intersections between the repo and sustainable finance. looking at the potential opportunities and risks from the perspective of the underlying collateral, the cash proceeds, as well as the counterparty. The paper was published alongside a list of relevant consultation questions where we asked for the market feedback on the subject. This was an extremely valuable exercise and promoted a broader discussion in the repo community. You can find both the paper and the summary report of the market response on the ICMA website. And building from this consultation result, we are now considering with the ERCC next steps on the topic in close coordination with our executive committee of the green and social bond principles to ensure a consistent approach. So without further ado, let me introduce our panelists in brief. We have Gareth Allen, Managing Director at UBS and also the Chair of ERCC. Claire Kuster, Managing Director at Deutsche Bank and also the Global Head of ESG for Fixed Income and Currencies. And finally, Sam Crawford, Head of Secured Funding Structuring at BNP Paribas. Welcome all. So today we'll begin the discussion with some general remarks regarding the role of repo in sustainable finance, then moving a bit closer to look at some specific practical use cases, and then lastly to touch upon some risk and uncertainties ahead. And then we will have an opportunity for very short Q&As where you can submit your questions in the Q&A box below. So I'm going to kick off with my first question. Obviously, sustainability is rapidly evolving to a mainstream feature of the international capital market, and there are undoubtedly very good reasons to embrace the concept of green and sustainable finance. And I think repo market clearly has an important role to play here. So what do you think are the key benefits that the repo can bring to this market? And Gareth, maybe you can kick off first and others can come in as they wish.
Yeah, okay. Yeah, thanks, Arne. So I totally agree. You know, sustainability is currently, much higher on the agenda than ever before. The ERCC recognised it was a topic that we needed to explore further in the context of repo market and the wider secured funding. I also think we need to recognise that we're also at the very start of discovering what it even means for our market, and also to be honest, what it doesn't mean. As Torsi said, repo and secured financing is a very significant portion of balance sheets globally. It's a very key mechanism to transmit liquidity through the whole financial system. So it's vitally important that we work on the problem, right, and start to figure out what it means from a sustainability perspective. Just like corporates and governments, they're also trying to figure out how sustainable they are. Financial institutions, whether they're banks, asset managers, or otherwise, all trying to do the same. So we need to start to look at our market. What do we do? The different applications for repo, collateral optimization, other secured financing, and then maybe just very objectively start to break down the activities, the strategies, the different purposes, and just to determine systematically whether we feel they're a force for good in the world or not. But what's definitely clear is it's not simple and not clear cut, as Godfrey alluded to. We saw that come through in the survey, and it won't be easy to figure it out in the short term. I think we started the journey.
Claire and Sam, do you want to add?
Yeah, sure. Happy to kick off from my side. I mean, as Gareth said, I think we're very much at the beginning of the journey here. And I agree with the comments of Toto that the repo market clearly has a very big, important role to play, given that the liquidity it brings and the specific transactions in terms of lending between the financial sector participants that are very active in this space and what they can do to help support the mobilization of capital towards green and social purposes, but also help in the transition through sustainability linked repo. So if you look at some of the transactions that we've done at Deutsche Bank, they sort of really hit two pillars in the sustainable linked market. One is the green repo, which we recently closed with M&G, whereby essentially we used GMR repo technology to help mobilize lending for ourselves. So taking in liquidity from our institutional investor base and channeling it into our green financing framework, which is a framework that we established a little bit over a year ago and initially was used mainly to tap the market in green benchmark bonds. but we since expanded it to allow us to raise liquidity through repo and deposits. And it really goes to the heart of how we manage our liquidity position for the green assets that we lend on our balance sheet. And those are our assets which mainly are in the renewable lending space, but also in energy efficient real estate, and have a profile which is both short dated, amortizing and prepayable. So it was very important for us to be able to have the flexibility to raise liquidity in the short duration market to be able to affect that asset liability management. And then the other transaction that we closed a couple months back was a sustainability linked repo. So very much looking at what's been done in the sustainability linked bond market and the sustainability linked loan market, and applying that technology to the repo market. Repo is a very important lending tool for us, especially with both developed market, but especially in the emerging markets. And the first transaction we did was for a Turkish bank called Akbank. And here, we worked with them to develop KPIs and targets in respect of their own ambitions on the ESG side, and apply that to the repo transaction that we provided to them.
I think maybe just to follow up on my side, I think the role or benefit of repo in the market, I think the main aspect is always going to be, as Gareth said, the main role of the repo market is to provide sort of a functioning liquidity and infrastructure for the collateral market. That's the key element. And in the context of collateral, I think we would probably focus on maybe 3 different categories of collateral, which will be, which will have a specific focus in the context of growing ESG focus, which would be, first of all, the green and sustainable or social collateral. Maybe I'll call it as sustainable collateral as a group. And there, the role of the repo market is obviously to provide liquidity, and we start to see that already through the Eurex basket, which has been announced, tri-party sets, which are having, dedicated sort of sustainable baskets. And then maybe conversely, you also see the sort of penalties coming in for more brown collateral, and specifically buy-side collateral takers who are looking to exclude brown assets from their collateral policies. And I think maybe a third angle is less about sort of promoting liquidity and penalizing conversely, but just general management of collateral. I think we see a lot more on the buy side, institutional investors looking to be more activist in their management of non-green assets to sort of positively affect change. So I think there was BlackRock recently announced that they would take a much more active role in collateral management. So I think that will be more and more a focus of clients in terms of recalls and voting rights and so on. So I think the main role will always probably be in the infrastructure for the collateral. Then obviously I think, of course, as Claire alluded to, there's definitely a role for green and sort of sustainable repos as a sort of dedicated asset class.
Yes, definitely. Thank you. And Claire actually already touched upon our second question, but if I can turn to Claire and Sam for a moment. You have, of course, been very active in the area, and as Claire already introduced, you've done some very interesting transactions with your counterparties related to repo and ESG. And could I ask you maybe just to kick off by describing what those are, and then also to speak about the key challenges and the lessons you came across when you're trying to put these transactions together? If Claire, you want to start, and then we can pass on to Sam.
Yeah, sure. So I think the different types of repos we've done presented different types of challenges. So I think when we looked at the green repo, we very much focused on the use of proceeds and making sure that we had a framework around the application of those use of proceeds, the reporting around that, the asset liability management around that allocation. So that was very much, what we looked at for that. And again, leveraging off of the program that we already had for our green bond, and expanding that was obviously a very helpful starting point for us. When we look at sustainability linked repos, it's very different. The challenges there, are very much linked to, for example, starting to think about how you manage the collateral differently or the same for sustainability linked KPIs and the penalty and rebate adjustments that might occur during the transaction lifecycle, and how those might affect the collateral that you take in or release, the margining provisions, the closeout of the transaction, and what it entails. When you're inter-period and you don't know whether the targets have been hit or not. So those were some of the challenges. Obviously, very, very different between a use of proceeds repo versus a sustainability linked repo. But yeah, that's kind of what we focused on.
And on our side, I think it's been quite similar, the approach we've used for our sustainable and green transactions. So we've traded with clients in Asia and the Americas and Europe in varying forms of green and sustainable repos, using both, as Claire said, the sort of conventional use of proceeds approach, and also on the sort of sustainability linkage approach. I think, Jen, overall, why I think it's an interesting topic. I think the reasons why clients are using green repos, I'll call them as a category, is similar in the way why repo overall has evolved over the past few years, thanks to sort of initiatives like TLTRO. You've seen a natural extension of the maturity duration of the repo market. So whereas it used to be just a sort of core money market product, we now start to see repo being used more and more on a term basis as a sort of financing tool for issuers in the market. So and that sort of applies in the same way to green sustainable assets. So whereas we've seen more longer term repos, and it makes sense because repos are cheaper than issuing bonds because of the daily margining and over collateralization, etc. So there's been a rise in long term repos, and I see every reason why green repos can play a complementary role to green bonds for precisely the same reason. It's a secured instrument, so therefore it's cheaper and more available to certain issuers than would otherwise be the case for unsecured instruments. So again, just maybe to make a precision on the products in terms of technicalities, where we focus on green repos is we're looking at the repo as an asset itself, which is a focus on the cash leg. So for us, a green repo is not about the collateral, which of course stays on the seller's balance sheet. So we really focus on the asset for the buyer, which is which is effectively a secured loan type asset, a reverse repo. So therefore the collateral is less important for us in the determination of the green or sustainability linkage. Of course, it shouldn't detract from the overall objective, but I think the key is to ensure that the cash, either through the use of proceeds or through some sustainability linkage, so some KPI, is key. But I think it's definitely evolving, and probably one of the main challenges is that it's a new market, like any new market, and we try to align to the principles that are there, the LMA for the loan side and ICMA for the bond side. But obviously today there are no principles for repo, so we're very much guided by those precedents.
Maybe I can just add from like a treasury and an investment portfolio perspective, and to make it as simple as possible. So managing investments, I can choose what to invest in, right? I can hold cash, I can buy a bond, maybe lend some cash through a repo or a secured structure. And if I buy a bond, the market's already got quite an advanced framework, what set of principles I can use, or I can start to determine how sustainable my investments are. I can look at the issuer and its credentials. I've got plenty of data out there on how to maybe rate issuers on, you know, how sustainable it is or it isn't. I could look at the issue itself. So you've got obviously the green bond, social bond, pandemic bond, even the ICMA's green bond principles, extremely robust, an established framework for determining whether my investment is sustainable or not. But when I look at secured financing investments, repo, how do I think about that, right? I'm lending money to someone, right? If I look at reverse repo, as Sam's just mentioned, you know, do I know what they're doing with the money? That's the use of proceeds concept, which is really important in the green bond principles. Does it matter? Do I care who I'm lending the money to and my opinion on them as an institution? Do I care about the collateral at all that they give me in the repo transaction? Do I care if it's a green bond or if it's just a vanilla government bond? What if it's a corporate bond from a market sector that's considered not very sustainable? Am I somehow facilitating that sector somehow by providing my financing or leverage? So it gets complicated, and it gets complicated quite fast, you know. But as an investor, I need to start thinking about these questions and how to answer them, and also how do we build a framework to help understand more. And I think we also need to then get very specific about some of the terminology, right? The use of language, and because this is all new, you know, that's where we are at this beginning stage. We need to define exactly what some of these things are and what they aren't.
Yeah, definitely. And maybe just following up from that as well, and you know, looking at the feedback from our market consultation, there's still clearly many concerns out there on the topic. And from our survey, some top considerations around, for example, greenwashing, more to do with maybe the fear of mislabeling or incorrect classification of the transactions, or the double counting, you know, if you count the green asset twice, etc. And also collateral eligibility, as mentioned in the previous keynote, and also some other operational challenges. So what do you see as some of the key risks and limitations still are out there? And if anyone would like to start.
I'm happy to kick off if okay. So I think you probably answered a lot of your question within your question directly, but I think definitely the biggest risk to the market is greenwashing. And I think, you know, that's that would be, you know, it's the big risk to the market's credibility. So I think, you know, I think we have to be extremely careful to make sure that, you know, if you did a repo on a green bond and then you refinance, or you do a reverse repo on a green bond and then you refinance that with a repo, someone else has done a reverse repo on that same green bond, and it will go on, to infinity. And we can't call all of these green repos, or else we'll have, so I think that, I think we have to be very careful about, you know, about the sort of nomenclature around the product, what we can comfortably classify, and definitely address all of these the concerns that sort of Gareth touched upon earlier. You know, it does get complicated quickly, and I think, you know, clearly that work has started thanks to the ICMA survey and the takeaways from that. And I think it's probably quite straightforward. It's probably quite clear that, you know, a defined set of guidelines will be like greatly welcomed. But I think I wanted to mention one thing, that I think, although greenwashing is a big risk, I think arguably a bigger risk to the market would be inaction. And I think we shouldn't. We also want to encourage innovation and make sure that you know, people are not scared to pursue ESG initiatives in the market, and we need to provide a forum for that. But I think inaction and fear of action is as big a risk, if not greater.
Totally, I agree on the inaction point, Sam. You know, and also Zan, agree. You know, it definitely showed up in the survey. The whole, you know, the greenwashing and the risks of dressing activity as sustainable or not, that's definitely on people's minds. And I also think it's not simple. there isn't a binary classification that something is sustainable or not. And I think as an industry, we just need to start, to be totally transparent about what we're doing, why we're doing it, and how we're transacting. And then it's for investors, shareholders, any other stakeholders to then determine what they think and act accordingly. That's all we can do. And I think it's also quite early. It's very early to judge anything. All the transactions out there, and opinions people have. It's really early to judge. We're only just starting to figure this out as an industry together, and just build some of those foundations. And what sort of framework that helps the transparency and the understanding, and also building, as you say, it's building the library of terminology around, what do we call all these things and why? What are they? And that's going to take time to do as an industry together. Yeah.
I agree with both what Gareth and Sam have said. I mean, I think we really need to be careful of not having perfect be the enemy of the good. I think we need to remember that. And I do think there are different ways, even in the bond markets, there are different ways that investors invest and define sustainability. Some define it, simply by exclusion of, sensitive sectors. Some of it look at it as investing in best-in-class ESG companies, and some define it by really what the impact of the investment is. All of those are different, as Cicero would say, shades of green, if you will, of ESG investments. All suit different strategies of the investors, and I think it's important to put a box around what the product is and what the label is, but I think it's important to give also the flexibility to allow the market to develop, because what would be the worst is if we don't actually incentivize liquidity to go into the market. That would actually be counterproductive and restrict the investment flows that are going into some of these activities.
Definitely, thank you. And my last question is literally just kind of, you already mentioned it, but again, just looking for our consultation response, I think there's, people want ICMAs to continue engage and embrace the concept, and there's also a clear demand for guidance or standards at the market level, especially because regulation haven't been looked at that direction yet. So in order to continue the development, and maybe Gareth, you can make a start, what do you think we can really do from an ERCC perspective? And you touch about that, for example, like building definitions, but also Claire and Sam, you may want to add what sort of guidance can really be beneficial to the market participants.
So look, I think as a conclusion in our paper, we committed as a group to setting up a working group to look at the topic. Right, that's a given. The market does want us to look at the topic. I think we need to, as I mentioned, we need to start building. Maybe start with this set of definitions. Work out what flavors of secured financing and repo there are in the context of sustainability and what it might mean. Maybe start to think about some of the interactions between. Repo sits in between, many types of financial institution, and also different markets like the cash bond market, right, where you've got investors looking at what they can do to buy assets or green investments which directly finance the right initiatives. But then repo is then a tool to finance those and refinance. We can provide leverage to institutions to be able to do more financing. That's what we're doing. The banks are pushing leverage into the market system using the product. And then maybe the output is to start with, just classifications. For example, is this just a repo with green bonds collateral underlying, right, with no opinion on what does that mean, whether it's sustainable or not? Does it even mean anything? It just is what it is. Is a repo lending money to a counterparty which is totally dedicated to investing in the renewable energy sector, and so on? Does that mean something for the repo itself, or the activity, or the classification on your balance sheet? I just know that I need answers to some of these, or at least to start to think about a framework, how to assess these things. I think we need to then we'll work together to set up those definitions and maybe a framework to help understand and add transparency in the early stages on the topic, and also just not try and run too soon. We don't have to rush this thing because the whole topic is changing very, very fast, I think. And we're right at the beginning of this.
Claire and Sam, do you agree? And then is there anything other than sort of classification you're thinking of can really help you, especially during, you have, given that you've done some transaction in this field? Is there anything particularly difficult when you join that process?
Yeah, I mean, I think from my side, definitely, what Garrett mentioned in terms of, industry sort of best practices, right? In the same way that, ICMA's published that for the green bonds, for sustainability linked bonds, and LMA has done the same. And then recently ISDAS has done the same for sustainability linked derivatives. I think it just helps, clarify the industry position without, boxing it into such a point that there's not enough room for the market to develop, but it sort of acts as a baseline for what is acceptable, and then the best practices evolve and have evolved. If you look at ICMA and LMA guidance, over time as the market develops. So I think that would be certainly a helpful starting point.
I think, Claire, as well, it's this customer demand point, right? So if customers are demanding a product or a type of product or a structure, then it's our jobs as financial institutions to create those and bring them to market as well. So we don't want to stifle that too early before we've explored the whole topic. And it's all about what market participants want at the end of the day, and that's what we're here for as an industry institution as well, to kind of work that out and maybe set a bit of a framework, or at least help people understand the topic as best we can at this stage.
I don't have anything to add. I think I completely agree. Basically, it's a bit of a forum to explore, to share, both between buy side, sell side, sort of some transparency about. I think transparency about the nomenclature is important. I think that's quite intimidating for many people. I think that's quite key. And then, yes, just some sort of guidelines and transparent communication, and probably through ICMA as a body is makes sense.
Yeah, definitely. So thank you very much for that and for your insight. And I think now we can move on to the questions from our audience. Gottfried, if I could pass on to you now to go through some of the questions from the participants.
Yes, one question is, what's the perspective of the panel on fossil fuel companies who increasingly look to capital markets as a source of finance due to the decrease of availability of bank debt finance, right? What ESG obligations are relevant to asset managers in relation to non-diversified coal and gas companies? So it's a bit like what I saw in the Financial Times this week, right? In the energy crisis, people dumping the shares of oil companies and hedge funds buying them because the spread has gone increasingly too wide, and we still need to have fossil fuel as well at the moment, right? We can't just go green totally. So Garrett, what was the role of repo in that? How can we police it?
I think that's a really interesting topic. Actually, there's this. For those who are more familiar on the topic, there's a really interesting catch-22 in sustainable financing, right? And I was looking at this exact thing with a purchase a couple of weeks ago, where you've got an issuer coming to market who is maybe in an industry that is deemed less sustainable, right? So fossil fuels, the wrong energy sectors, but they're one of the sectors which can have the biggest impact in making a difference. So if you think about this whole topic of transition, they can really make a massive difference if only we help them. So if you kind of take the view as an investor, you want to completely abandon ship, and leave these industries behind, that is not going to help the industry's transition. The industries need financing to be able to, to do better, to do more renewables or whatever the objective is. So they need us to do this. So I don't think we should be abandoning those sectors. We should be enabling somehow, whether that's through green bonds, green bond issuance, or through the financing markets. Banks should be helping that transition process. Absolutely.
Yeah, I think the role of the repo market is not to police the market. So we're not the police here. We're there to provide liquidity and infrastructure for the collateral market. The fact that bonds are issued and there are buyers for those bonds is beyond our control and mandate. I think, again, a point I touched on earlier is you do see clients who are less willing to take sort of brown collateral, which I take Gareth's point that positively influencing certain issuers can affect change, but we have to just respect the market, and there will be some clients who will wish to exclude certain industries from their collateral universe. So, and I think there've been some recent speeches from I think the governor of the Bank of France. I think we had various comments about more constraints around haircuts and less eligibility within the ECB. So I think it's interesting. I think there's this sort of, I think I would probably leave that type of comment more to the politicians who are there to decide what is acceptable and not, and on the repo market to ensure that we continue to offer the clients the flexibility and the technology to support their sustainable journeys.
But one of the lessons of the past is, regulators always are behind the curve, right? So we're kind of pushing forward, and then something explodes, and then we get more regulation. So could we prevent this, to have an explosion of, I wouldn't call it bad behavior, but wrong investments or wrong focus? Like, one of the things, Gareth, we discussed, should it be only tri-party? Should it be only long-term repo? Should it be overnight Tomnext, where you as a repo guy can never control what's the collateral quality behind it? These are questions that...
I think we do need to avoid like a knee-jerk reaction to all of this, because look, all of these, call it the dubious industries or exclusion style industries, they all know the world is changing. Of course they do, right? And it's probably the only topic on the, in the boardrooms of all of these big institutions on how do they deal with this immense problem, and what do they do about it in terms of like future strategy. So they're working as hard as they can on this problem, and we have to be careful not to be complete knee-jerk reaction to make decisions, exclude collaterals, very, very quickly. Because also remember, one of our key roles in the financial markets is to be that transfer of liquidity, right, and safe functioning of the financial markets. We're at the center of it. We're the lifeblood of that as I guess a product or an institution. So we kind of need to go on a journey, and we're at the beginning of it. But yeah, I just think it's very dangerous to go too quickly and to make rash decisions on these things. But then also understand the needs of the customers, right? Investors are changing behavior very, very quickly as well. We need to be cognizant of that.
That sums up very much the rest of the questions I've seen here, the green washing, brown washing, orange washing, whatever color of the rainbow, right? It's going to be a challenge for these markets. On that note, I will close the panel. Thank you, Sam, for moderating. Thank you to Sam, Claire, and Gareth to always be there. And we hope we can talk about this again in the next ERCC AGM, when we have another 6 months of experience and pitfalls, hopefully, and also profitability for these markets. Before I introduce the next panel, I'd like to mention a recent publication by the ECB that is really important for those who have joined the financing world pre-sovereign debt crisis. It highlights the massive work done by the regulatory community together with the markets, including obviously the ERCC. The link is on this page. Use it for education purposes, something I personally believe is highly important in this area to understand what's coming up now in the next panel. When the ERCC created the operations group, we had a vision that within a few years, all that boring settlement stuff would be solved. Well, we have been optimistic and some things have improved, but more has to be done. One of the most interesting discussions we had in the last year was helped by data we collected, putting our finger on the wound. How can we improve settlement in Europe with vendors all over the place, digitalization, common domain model, faster connectivity, Zoom, Teams, whatever tools we use? Does it solve our issues? And will it satisfy the regulatory community? In light, in particular, of CSDR and the potential mandatory buy-in that's now high on the fire. Alex will do this panel, so I give it over to you.
Thank you very much, Gottfried, and good afternoon, everyone. I'm Alex Weisfall. I'm the secretary of the ERCC and very pleased to moderate our second panel for the day, focusing on settlement efficiency. Now, as Gottfried said, and he mentioned a number of related topics, issues around settlement and the key underlying infrastructure, in particular here in Europe, have always been very close to the heart of the ERCC. We had numerous discussions over the past years in both the ERCC committee and, of course, also the ERCC operations group. Of course, we also see now a lot of additional momentum on the topic as firms are getting ready for the looming implementation of CSDR settlement discipline in February next year. A lot of that focus has for very obvious reasons, been on the mandatory buy-in rules, which clearly are the most problematic area in CSDR. Our concerns are certainly very well known, at least I hope so. There is a separate update, I would note, by my colleague Andy Hill among the pre-recorded updates, which is specifically on those discussions around mandatory buy-ins. So that's available on the website, so please do have a look. Those have certainly been more encouraging recently as the co-legislators in the EU seem to have now understood the problem and also the urgency, and seem to be working on a creative solution to achieve a rather last-minute decoupling of buy-ins from the rest of the settlement discipline measures, which we still expect to go live in February next year. But what we wanted to focus on today is really more, or are really more, the practical aspects of settlement efficiency, looking also at the opportunities that this presents, this overall focus on the topic, and to discuss some concrete improvements to help the industry and reduce fails, ideally ahead of CSDR, but also, of course, more broadly. So we already had a panel at the previous AGM in March on this topic, and also our related ERCC initiative. But given all the discussions we've had since then, we thought today is a really good opportunity to provide an updated view and add some new perspectives as well. And I think our panel is certainly very well placed to do that. So let me introduce our 4 panelists today in alphabetical order. We have Vlad Lukic, Managing Director and Head of Sovereign Repo at JP Morgan, and also a member of the ERCC committee. We have Sachin Mohindra, Executive Director, Market Solutions at Goldman Sachs, and co-chair of AFME's Post-Trade Committee and CSDR Task Force. Then James Upton, Commercial Services Director at LCH and co-chair of the ERCC Ops Group. And then last but not least, we have Jean-Robert Wilken, Executive Director in Banking, Funding and Financing at Clearstream, and also a member of the ERCC committee, of course. So thank you very much for joining. I think that's a really good group and broad perspectives. To set the scene for the discussion, let's start by looking at the current situation in Europe in terms of settlement efficiency. We put together a couple of slides with some headline figures, which are all from a really useful and detailed analysis that the ECB prepared, and that was as part of a work stream on settlement efficiency, which has been led by the CSDs. But we're also represented on that group through Nick Hamilton, who's co-chairing the ERCC Ops group along with James. So if you look at slide 1, I won't go into detail here, but these are the headline figures from the ECB analysis, at least the relevant ones for our purpose. The objective of that work was to produce a figure that follows the CSDR definition of fails very closely, which differs somewhat and is in fact broader than what previous figures have captured, which focused more on the technical efficiency of the system. So the resulting figures are in fact a few percentage points lower than the previous measures. We see here for sovereign bonds, we look at efficiency rates in the range of 96 to 97% in terms of value and volume. For other bonds, this is slightly lower, especially in volume terms. Important to note, this was calculated using February 2021 as a representative reference month. Then slide 2. So here we see the efficiency rates across the different asset classes, and we see that varies quite significantly. You see on top for fixed income and a little bit lower are the rates for equities and particular ETFs. And then the final slide, just to show that fail rates can actually also vary quite a lot over time, in particular in times of market stress. We've seen this quite clearly in March last year, where the efficiency rate dropped quite significantly. So that just to set the scene and give you a bit of a picture. So with that in mind, my question to the panelists. So if you look at those figures, do you think we have a problem in Europe with settlement efficiency? And more specifically, perhaps also, where do you see the bottlenecks and problem areas? Lav, let's start with the dealer perspective. Where do you see the problems, and why does settlement efficiency matter to you?
Thank you. Thanks, Alex. So, I mean, look, looking at it from a dealer perspective, and particularly, as a sovereign perspective, it's probably wrong to say that the market is not functional on a BAU basis with a sort of 96% settlement rate. But you're right, in the last slide you mentioned, this does rise to sort of unacceptable levels at some flashpoints, such as last March, where we saw a drop of 10 plus percentage points in some markets. That may be a scenario that we can't necessarily avoid, but we should look to address BAU efficiency, which is within our grasp, that would translate to sort of smaller amplitudes and a greater degree of protection at these pressure points. So, we can argue about if a 4% BAU fail rate is something that we should be concerned with. But from my perspective, what it masks for dealers is the problem that the cost of maintaining the settlement efficiency is rising. The last decade's trends of consolidation in the market and the lack of dealer stock warehousing has left a smaller amount of dealers being providers of liquidity. It follows that changes in a single large dealer's behavior can have proportionally larger effects on market efficiency, as well as the fact that this cost of settlement is to a large extent centralized with a smaller group of dealers. I think in the current compressed spread environment, even small moves in the wider market efficiency of settlement make the cost of maintaining those levels of settlement efficiency that are better than the market average uneconomical in comparison to the value of the trade. So, why should we care? I mean, this in the long run leads to the increased price for clients' access to liquidity. But more likely in the first instance, changes in dealer behavior to try and avoid this cost of fails and this auto borrow cost that they're incurring. And this change in behavior in turn affects wider market settlement efficiency. So it's a negative feedback loop that we need to look to address. To me, to set the stage, the answer is not necessarily to succumb to the knee-jerk reaction of, increased penalties that really provide a counter incentive to the provision of liquidity. The positive solution, which we've, discussed, will come on to, is relates to some of the obvious points that we looked at in the ERCC, such as, auto shaping, auto partialing, improving auto borrow programs. And some of the analysis done by the group, which we touched upon later, indicates that, for instance, for auto shaping, we can bring about a 1 to 2% improvement in settlement efficiency. Auto partialing, if commonly adopted, could bring about another 1%. Both obviously naturally resulting in a lower cost of auto borrow and therefore increased participation in the program. So if addressed in turn and an industry-wide level, I think the effect could be cumulative, and we should strive for, indeed could achieve, close to perfect settlement with some of these.
Thanks, Lav. That's really a helpful overview to start. Sachin, what is your view on the current situation?
Sure, thank you, Alex. And I guess looking back to your initial question of, do we have a problem in Europe? And actually, if we look at it in isolation, where you say, well, mid-90s, yeah, it's pretty decent. And like we mentioned earlier, there's an increasing cost to support the operations behind a higher settlement rate and efficiency. And it's a fine balance. I mean, the closer you try and get to that 100%, the more costly it becomes. And so I think the industry in Europe has found a balance where, not to say there's an acceptable level of fails, but we found a way to manage the volume that we have across the industry with the utilities and the tools that we have available. I could argue that we don't use some of those utilities and tools as much. Like Lav mentioned some of them, and we'll go back to them in a bit. If you then compare it more against the globe, and then you look at the US market, okay, bear in mind that it's one large market with a finite number of siloed infrastructures, which makes it easier to manage the start to finish life cycle of that transaction. With the addition of more affirmation, clearing and more activity, all that leads to a much more efficient market. Then you look at the Asian markets, which are very, very heavily focused on pre-settlement day matching, pre-matching, and position management, such that failure is not even an option when you get to settlement day. So when you compare Europe to those two regions, then maybe there is a bit of work to be done. And CSDR, as much as we've talked on a number of occasions in different forums around some of the challenges of CSDR, the actual principle and sentiments actually do allow for us to really think about how we work on our operation and where do we find those efficiencies. So whether it's introduction of penalties, which clearly will charge us, the larger the fail, the larger the penalty, that will certainly give us more of an incentive. I guess looking back at the statistics you showed earlier, I mean, when you look at the different asset classes, to be honest, I was a little bit surprised to see that the corporate bonds were as high as they were in terms of relative to the government bonds. And I think one area to really consider, and I think for me, corporate bonds and high yield is really a key concern within the context of CSDR. But we have to understand why are there some varying levels between those asset classes. Clearly, with government bonds, you have a fully established primary dealer market, key primary dealers making sure there's always two-way liquidity in the market. And also you have clearinghouses. I'm sure James will touch on that later on as well. There's clearinghouses who are, I would say, policing, or James may have a different way of phrasing it, but policing the market to make sure that there's not only netting compression, but there's also the in and out flows in the most effective way across the industry. We don't necessarily have that in the corporate bond space. And so therefore there's lack of, let's say, of that level of policing. And I think it really comes down to industry participants to then work on solutions to identify efficiencies there. However, that's where I feel CSDR, if it was implemented in the correct way, could act as actually a good catalyst to achieve further efficiency in the final few percentage points that remain.
Okay. Thanks, Sachin. And before we come on to the ERCC discussions, we should certainly not forget the CSD perspective. So Jean-Robert, any thoughts on the status quo from your side?
So obviously, to support the idea that the ERCC has worked for months now, as you just explained, Alex, on this improvement of settlement efficiency within our repo and collateral space. Status quo is not an option, and Sachin and Lav have just explained also why we need to improve it in our industry. But maybe coming back, we are still defining the scope of this discussion. On the EU side, the reason they came up with CSDR and settlement discipline regime was exactly for what Sachin described. There are other markets which have much better settlement efficiency than the European markets we are dealing with. And so that's exactly to address that point, because settlement inefficiency does not bring confidence. It does not raise confidence of foreign investors. So there is a political element behind that, but nobody should forget. We are at the verge of implementing that. It's a mandatory change. It's painful, but there is a reason behind, which is improving the attractiveness of the European markets, and settlement inefficiency in comparison to other markets might also refrain some foreign investors to invest. And to also insist on that, then there are two different angles as well, because we are already in this discussion per se, because it's the ERCC AGM, focusing on our repo and collateral markets. But we should not forget that the main aim also of this legislation, the settlement discipline regime, which we'll talk about a bit later. So the need to improve settlement efficiency, as demonstrated in your figures, Alex, is also on the equities and ETFs and UCITS markets, which is, indeed, do we really need to make a lot of efforts to improve settlement efficiency by from 96 to 99%, as Lav explained very well? Yes, there are reasons to do it for us. But when your market, equity cash, for example, start at 85% settlement efficiency, then there is a lot to be done there to improve it. 85% is unacceptable in our, advanced market. So that's also something we need to keep in mind, why we have those mandatory changes coming to us, and why it has been imposed now, because some practice have not given enough satisfaction to the overall market and the investor community as well. So that's something which is, I think, important to keep in mind when we're starting this discussion. It's not only about repo and collateral here, mainly fixed income, sovereign debt, centrally cleared market, or whatever other fixed income and corporate debt market. It's also a lot of the changes which we are facing now for the next in the next 4 months is also due to the equities and fixed income, equities and UCITS and ETF markets, which, as you have seen on the graph, have a much lower settlement efficiency. So that's certainly one point. And so that I just wanted to insist on that before we looked at the solutions and maybe the opportunities we have for our own market on the repo and collateral side.
Thanks, Jean-Robert. Okay, no, let's come on indeed then to those opportunities. And at the time of the previous AGM in March that I mentioned, we just had our initial workshop on this topic, of course, just of this current new push. As mentioned, since then, quite a lot has happened. So James, having led this initiative from an ERCC Ops perspective, can I ask you to give us a quick overview of the initiative and the discussions we've had so far, please?
Yeah, no, sure, Alex. And, it's really kind of just echo the thoughts of Lav, Jean-Robert, and Sachin already. I think, Sachin and Lav already spoke about kind of auto borrowing and shaping, which is some of the things that we'll get into. So this has been something that, as you said, has been happening for 18 months. The focus has been significantly on settlement efficiency, and that was a logical next step following the work on intraday liquidity, which preceded it. I think just going back to the last question before we get into some of the detail, I think, ICMA and the ERCC and the ERCC operations group, we see this not only as an important focus, but I think, as Lav alluded to, it's a significant opportunity for the industry kind of going forward in terms of the improvements that we can make. The work's been to date closely coordinated with the ECB, particularly AMI SECO, Alex, as you mentioned, through NIC and also the Settlement Efficiency Task Force. But pleased to say we've got Sachin here today representing AFME. We're also working closely with ISLA. Again, to Jean-Robert's points, this is not just something that impacts kind of repo and collateral markets. It's something that impacts at lending markets more broadly across the equities landscape as well. So we very much see it as a universal opportunity that we can help to solve together. I think the analysis and the data that Alex that you showed, I think that illustrates that if more industry participants are able to use the settlement tools, and I'll talk about the tools in a second that are available, then quite simply settlement efficiency rates should improve, and that provides cost, risk reduction, and also the intraday liquidity benefits to the market. So I think we can broadly conclude that settlement efficiency is, and better settlement efficiency is undoubtedly a good thing. I think the question now has become, how does the industry get there? And the ERCC earlier in the year, it issued 3 recommendations, one each around auto partialing, shaping, and auto borrowing. Now, the shaping recommendation was probably the simplest, and it was that settlements should be shaped into 50 million nominal shapes. Now, many firms, including CCPs, my own CCP LCH, we do this today, but the ask for it was to be more broadly adopted. And additionally, perhaps going further, the additional recommendation was that shaping should be automated and mandatory, similar to how the process works in the US and works very well in the US. Auto partialing a bit more nuanced. Today, firms do need to proactively opt in to use auto partialing at the CSDs and ICSDs. And so not all firms are opting in. So we really do need to encourage firms to do the work to opt in and not opt out to that settlement efficiency tool. We understand that some firms today have technical and operational barriers to not being able to use auto partialing. Perhaps some of the custodial community have that. So again, the ask is for us to work more broadly with those communities for them to be able to opt into those partialing and auto partialing capabilities. The final recommendation, again, I think Lab touched on this one earlier on, is around auto borrowing. And here it's that CSDs should offer auto borrowing programs to their participants, and participants should proactively opt into those programs to help them reduce risk and increase settlement efficiency. So I think that was the kind of 3 broad recommendations, Alex, that kind of where this came from. I think the question then became to how do we engage the broader community in these recommendations? And over the summer, many of the people who perhaps are kind of tuning in today, they participated in 3 targeted workshops, one focusing on each of the recommendations. Those workshops were based upon a survey which ICMA sent out over the summer. That survey was incredibly well responded. I think we had over 30 responses from member firms. So we had some really informed responses and data to really engage the community on these topics. The workshops were kind of really detailed, and we had some very good outcomes, which I'll briefly cover because I think it's important to understand the outcomes. The outcomes were that firstly, that auto partialing needs to be universally available to all participants, and we should continue to discuss with market infrastructures and also custodians how they can engage in auto partialing and really break down those technical barriers to make it available. Secondly, we need to think more about the take-up of auto partialing. So, trying to measure that take-up in terms of percentage terms across the industry, but also thinking about where there is concentration about where users are not using it. So is that primarily in the custody community? Is it in the prime brokerage community? Where does it exist within the sell side and bank community today? So really trying to understand that in more detail. Shaping, as I said, was a lot more simple. Everyone wants shaping. Everyone thinks it should be kind of automated and mandatory with appropriate industry and authority support. I think the other part of shaping though is where should it take place? And since the workshop, we've already started to have discussions with trade venues, the trade venues that we all use within securities financing, to see and understand their appetite for implementing shaping at the trade venue level. Auto borrowing, a little bit more complex. There were certainly some observations around the costs and the incentives for participants to participate in auto borrowing programs. And secondly, the availability of them. Jean-Robert and another kind of ICSD, they have very well used auto borrowing programs today, but auto borrowing programs really should be more broadly available within other CSDs. And we should really think about the economic incentives for users to participate in them as a tool to improve settlement efficiency. So Alex, look, I think progress is good. The engagement is really great. It's been fantastic over the summer, but it's now about everyone pulling in that same direction, getting the authorities to recognise the work, to openly support it, and then solving the remaining challenges.
Thanks, James. That's really useful. Let's then bring in the other panelists and dig in a bit deeper on each of these three issues or tools that you mentioned, James. So Sachin, can I turn to you first, focusing perhaps on auto partialing, which I know is a topic very close to your heart, having led the AFME work stream on this. So do you want to comment on that, please?
Sure, thank you, Alex. So yes, you're right. We spent a lot of time at AFME, probably a couple of years ago now, looking at partialing capabilities, partial opportunities across the industry. Really with the view that ahead of CSDR, our focus is very about fail reduction and risk reduction, but clearly from the perspective of the ERCC, clearly there's a key liquidity driver here as well. So what we looked at is clearly, partialing is not a new concept. I mean, it already exists in a manual sense today. Parties pick up the phone to each other, agree a partial, split a transaction. That's been happening for many, many years, right? But it's very inefficient. It only then works on the items that we have time to actually identify, pick up the phone and actually deal with on a case-by-case basis. But we looked at that as well, going, well, that already exists. What are the minimum requirements around manual partialing? Then we looked at the next step and saying, well, auto partialing has been available, at least in the T2S markets, as each CSD migrated in the waves over the last few years. That already exists, but is it being used enough? Now, with the nature of the way the auto partial works, the auto partial takes place at the central securities depository. So therefore, the CSD is where this instruction needs to get to, appear to be short to deliver with a partial available balance. Now, generally speaking, that only is then applicable to those who are managing their own segregated account structures at those CSDs. Because those operating omnibus account structures for their own risk management have historically never instructed unless the full position is available for their underlying client. And so therefore, what we found is auto partialing was great for those with their own accounts. So I guess in a lot of cases, dealer to dealer, it was pretty useful. When it came to dealer, so buy side to sell side, for example, then suddenly the uptake didn't seem to be as high. And that's mainly because of the fact that many of the buy side were sitting behind omnibus account structures. So therefore, T2S, I believe it was towards the end of 2019, introduced the partial release capability. So allows now that omnibus account holder to be able to not just hold all or nothing, but you have to be able to hold, but then partially release the available amount to avoid any risk of securities or stock pilferage from other clients in that pool. So that, again, was a very welcome change. What we found, though, is all these technical changes have been made, but there's no industry guidelines. There's no support in terms of how should we best use them. There's things like thresholds. There are things like timings, instructions. Should we default it on the account? Should we do it by instruction? And if I just go back to the thresholds, that was the key one, because if a CSD sets a particular threshold, we didn't want parties opting in, but having their threshold set higher. So you actually create more friction than what the CSD is looking to offer. So we put some guidelines around the fact that, threshold should be at the same level or lower than what the CSD is already offering. So if anything, you are adding more sort of settlement liquidity, or if not more, the same level of what the CSD expects in terms of whether items should shape at 10,000 euros nominal, et cetera, et cetera. So working through that, there was it's taken a lot of time. We've also engaged with the Investment Association to work with their clients and membership base to understand what are the blockers on that side. Like you say, there is a bit of technical change required to support this, but at the same time, it's not just with the institution, but it's that institution's custodian and their service provider, and then ultimately the CSD. Now, we know that CSDR mandates most CSDs in the EU to offer partial settlement, but it doesn't mandate the use of partial release, interestingly. So there is a bit of a gap there. So I think the next step is really to work across the industry, socialize the ability to partial, the requirements across the industry, what are the best practices to share, and work on enabling those options as much as possible. So we do see a two-way partialing capability. At the very least, allow the receiving parties to always mandate the acceptance of partials coming in, and have the delivering party potentially have a bit more control over their position. So again, these are all up for discussion and further dialogue between AFME, ICMA, the IA. But I do feel that the industry is now going in the right direction, again, especially with CSDR looming. Anything to reduce fail exposures, I think, would be welcome.
Thanks, Sachin. And let's come on then to the second issue. Lav, in our workshops, you've been quite vocal on shaping. Do you want to comment on the opportunities and challenges here?
Yeah, thanks, Alex. Thank you, James. You've pretty much more eloquently summarized everything I was going to say anyway. But look, I have the easier one, shaping, where I think we'll all agree that it's pretty much a no-brainer for the industry. And even mandating it will probably be the easiest of the three ones we'll discuss. But I guess the challenge for all of these is how do we achieve industry-wide acceptance without the mandating? With immediate impact, I see no reason why, we all agree to see no reason why it should be a 500 million trade failing and creating a fails chain because the delivering counterparty is insufficient to a few million of stock. And in the case of auto shaping, we would be left with a 50 million trade in this case, which the benefits are obvious. I think without mandating, we could start at three kind of incremental places, each of increasing value of impact. And the first is at the point of the creation of the client trade. And I think there was a question from the audience, from my good ex-colleague Andy Turry from GLMX, where the question was around how some of the platforms can help with this, and I think that's exactly where we can start. Shaping at the point of the client trade on the D2C platform clearly captures a segment of the market. Now, the segment of the market that it captures is related to the kind of type of stock or that the platform clears. So we may be missing some of the segments of the market. The next step to me is shaping at the CCP stage, and again, it's somewhat easier because the group of CCP members, professional dealers, as a smaller group, much easier to come to kind of an agreement on what that should look like and sort of what somewhat mandatory participation should look like. And finally, obviously, the catch-all solution is at the CSD settlement level in the way that Sachin's mentioned has been done in the US market. But it requires a wider range of market participants to accept this kind of protocol. But as I mentioned, it should bring about a 1 to 2% improvement in settlements efficiency, and then in the context of govies, we're looking at towards 98-99% settlement if with this piece alone.
Thanks, Lav, and we can come back to some of those points afterwards. But first of all, let's also cover auto borrowing, and on that, Jean-Robert, you're obviously best placed. So do you maybe want to add on that, and perhaps you will surely have some other observations on the other topics as well.
Yeah, observation on other topics like partialing and shaping certainly, but let's cover auto borrowing first.
Yes.
So it's probably at least for me, but for all, it's probably the easier proposal we're making here for a couple of reasons. Auto borrowing has been in existence for over 40 years in the ICSDs, at least in Europe. So that's best known and it's quite efficient. So it's been used for so many years by a certain number of market participants. Indeed, as Sachin insisted, mainly on proprietary trading and on accounts of dealers which have their own accounts and operate directly their own settlement. It's easier than through a custodian structure or through global custodian operated omnibus account. So that's maybe something we need to address separately, but it is also available and can be used there. But also auto borrowing allows for maybe it's also easier to implement as a first step than partialing and shaping, because it's an individual decision. So each market participant can do it and implement it at its own pace. So for partialing, you're also depending on your counterparty to accept it when it's optional. For shaping, the whole industry needs to be in agreement, and we are working towards that, and we want to work on that. For auto borrowing, there is no excuse. Each individual market participant can do it himself individually and at its own pace. And as Lav said, indeed, the settlement cost has increased overall, maybe for some of the dealers because of the concentration of activity with small dealers. But auto borrowing still maybe is only used by those larger dealers and most important settlement actors, and therefore it would benefit settlement efficiency if auto borrowing functionality was adopted by a much wider range of participants. And we have mentioned the few reasons why it's maybe the take-up is a bit less than expected, or it could be after 40 years of existence. But here, as a recommendation, before it becomes mandatory for certain cases and so on, I think the whole industry would benefit if market participants would consider implementing auto borrowing as a contribution to improve overall settlement efficiency. And I know it can be perceived as very expensive, but if you look at the operational consequence of failed trade, that's a very expensive gain. Failing settlement is painful to fix, and therefore the hidden cost of inefficiency in settlement is something which has been mentioned a couple of times or into the too, and the cost of borrowing securities. We refer to securities lending. A fair portion of securities lending activity is an activity of short coverage, and not only for speculations or whatever, but also for fixing failed settlement. So if everybody can contribute in implementing something as easy as auto borrowing, then it will naturally improve settlement efficiency. But it's not the only solution. As we said, shaping, partialing, and auto borrowing are three, I would say, pillar of the improvement we recommend for the 3, 4, 5, 6% settlement efficiency we want to gain in the coming months and years. So certainly that's something, and maybe something which I could hint on about auto borrowing to make a parallel with our settlement efficiency discussion and settlement discipline is as an ICSD. So we act as a provider of auto borrowing functionality, and for many years we have included in the auto borrowing rule that in case of late recall, when a borrower is recalled for some of the bonds he has borrowed in this auto borrowing facility, then to keep confidence, to keep the confidence and the contribution of the lenders, we have implemented cash penalties for late recalls and also binds on those securities. And in securities lending, binds is a voluntary thing, and it's not very popular, but Clearstream does it, and I'm pretty sure Euroclear does it as well. We also, on a regular basis, operate binds on late recalls. So if you make the parallel on auto borrowing with settlement, we have used those tools like cash penalties and binds to try to improve the discipline in the functioning of our auto borrowing programs, and that has worked for many years and has maintained the contribution of auto borrowing to maintain the settlement efficiency pretty high in the ICSDs, and I can have a word on the CSD side as well. So if we make the parallel with settlement efficiency, maybe cash penalties and mandatory bind in some cases, maybe not all, but in some cases, can be useful, and at least in auto borrowing it has worked for many years. So that's a bit of a proxy and analogy we can leverage. Now the auto borrowing, there was a mention, indeed has been in existence in the ICSDs, Clearstream and Euroclear for over 40 years, and both groups have also launched now functionalities to also provide auto borrowing functionalities in the respective CSDs we operate, and that is a contribution to improve the settlement efficiency on T2S, because as mentioned, shaping is there for the whole market. Partialing is now available on both CSDs and ICSDs, so T2S and the ICSD settlement platform. But auto borrowing as the third pillar, I would say, need also to be available in all security settlement systems, and T2S is one of them. So unfortunately, it has to be distributed through CSDs. So and provided by CSD. So that's what we have done already for the German CSD, for example, in the case of Clearstream, but Euroclear has done the same on some of the CSD they operate. So those solutions are there, but still on an optional basis. So that's what we need to discuss now on the next step. So how are we going to make the best out of those solutions that we have identified in these workshops of the ERCC?
Thanks, Robert. Are there any other views, first of all, on those areas?
I'll just jump in on expand on what Jean-Robert said about the costs from a dealer perspective. I mean, just briefly. I mean, look, like from our perspective, as a heavy user of the facility, auto borrowing is, largely or very much a positive fails mitigation tool that, got us through a number of different crises. So what's the issue with auto borrowing? Well, look, if I think back to like the collateral scarcities of the 2016-17, when the central bank programs were not fully calibrated, auto borrowing continued to provide a functional stop for the market, particularly because there is and still isn't no viable alternative to curing an overnight settlement date fail. At the time, rates in German specials were sort of deep negative, and the facility priced at 100+ basis points was relatively on the market. But what the emerging issue here is the dynamism of the facility rates being appropriate to the spread environment we find ourselves in. Why is this important? Look, I mean, if a facility is priced too expensive in relative terms to the specials population, it's starting to create a disincentive for participants to remain part of the program if they don't have to. So anecdotally, for the first time, as far as I can remember, the current environment of spreads is pushing a number of dealers to leave the auto borrow program. And this obviously has a clear negative impact on the settlement and increases costs of maintaining settlement discipline for those who remain part of it. So look, apart from mandating participation, which is an option, how do we incentivize people to be part of it? And the only lever I can see in this is some form of dynamic adjustment to market conditions.
Thanks, Love. Anything else? Otherwise, we move on to the next steps. I'm sure there will be more opportunities later on anyway to jump in. So okay, with that then let's look ahead. So what do you think should be now the concrete next steps for us to make sure we take advantage of the opportunity that we now have, if possible, of course, ahead of February next year? So James, can I start with you again, just basically recapping what we've discussed in the workshops in terms of next steps?
Yeah, no, sure, Alex. I think maybe before I do that, I mean, one of the things that I just observed from listening to Sachin, Lav, and Jean-Robert is that there's kind of, we feel as though these three tools are kind of real opportunities. I think one of the things I would say is that, clearly there is no one silver bullet here. It needs to be all three of those things working together to try and, take advantage of this opportunity that we have. I think the other thing is that we need to really acknowledge that there is a significant segment of the market that cannot today, for certain different reasons, easily adopt these recommendations. We've been working a lot with the custody community. We've been looking to understand more around the prime brokerage community, around the buy side elements. I think Sachin mentioned the different account structures that exist that don't automatically make it particularly easy. So I think we at ICMA and with the working groups, that should be one of our primary responsibilities now, really, following this first phase of work, is to really go and work with those communities, work with their industry associations to understand what those barriers are, technically, operationally, and really help them try and break those down and kind of solve them. Because I think it's all very well kind of solving this for the dealer community, who are perhaps a little bit more technically already there in terms of their connections to the CSDs and the tools that have available, but we really need to be thinking about how we can bring all of the market kind of along with that. And I think that really kind of goes to some of the broad next steps in the recommendations. So firstly, we need to be able to communicate out, the work that we've done to date and these recommendations. I think having events like this and the working groups and the committees is great, Alex, but I know that, you're working on a white paper that we're looking to issue out into the industry as well, really summarizing where we are. I think it's great to have Sachin here, but we also need to engage, the Investment Association and the other relevant kind of buy side and custody, trade bodies as well, to really kind of get this message out there. I do think that the dialogue with the regulators is kind of continued dialogue with the regulators and the authorities is really important. Firstly, I think having this prominent within the AMI-SECO meetings, making sure that it's raised in those meetings is kind of really continues to be really important. But secondly, how are we going to measure the success of this? So let's say we're back here in a year's time and we've made some progress and more of the industry is starting to use these tools. How do we know what percentage change that has led to in settlement efficiency? So working with the CSDs, working with the ECB for them to provide us with that data for us to be able to measure success, I think is really important as well as the next step. And I think the last thing I'd say on this point is Jean-Robert mentioned about spreading this to kind of, thinking about the corporate bond community, the equities community, completely agree. The other part of our own, perhaps closer to home though, is the fixed income cash bond community, certainly within the Govy space. All of the tools that we've spoken about not only apply to securities financing, repo, set lending, they equally apply and eligible for the cash bond space as well. And to that end, we've started to engage with ICMA's secondary market practice group who represent the cash bond community. We really need to ensure that it's not just a securities finance thing that this kind of works for, it really applies more broadly across the industry as well.
Raf, can you answer that question that came from the audience on the carrot and the stick?
Yeah, I mean, look, so the question is obviously on penalties and fails and what we can do in terms of create a stick as a standardized settlement fine, such as like the US and Japanese markets, and is it achievable in Europe? I mean, obviously, if we refer to somewhere like the US where TMPG is a feature, it requires a homogeneous market where we're able to pass this fail on to the final, I guess, offender. In previous iterations, certainly over the last years of European penalty regimens, we've seen that centralized largely to the dealer community. And in fact, I feel like it's had a sort of diminishing effect on improvement of settlement discipline, and probably in the long run, a negative impact on end user cost as well as liquidity. So I think, to me, that the point about penalties, it starts with the assumption that there's a behavior that needs to be punished. In a market, for instance, like I keep referring to the sovereigns, but in a market where it's 96% settlement ratio, we have to start with a different assumption, is that dealers are not trading to fail. If a fail occurs, in the vast majority of cases, it's either due to the operational problems of the dealer itself, or the other portion is inefficient setup of either the dealer or the market itself. I won't delve into the detail of those inefficient setups, but we all know what some of these are. So speaking from my firm perspective, and indeed any firm that runs a high volume business, a low fails ratio is key for our business, not just from a reputational perspective, from a cost perspective. And I can tell you with confidence that none of the notable fail chain situations in the sovereign space where we were responsible would have been cured or prevented by a fails cost or a penalty. But indeed, a better auto partitioning, auto shaping would have. So the question we need to ask is, what are we trying to improve? Like, are we trying to improve settlement or increase the cost of failing? Because if my initial assumption is correct, they're different things.
No, it's all about, how can we improve settlement efficiency, right? And Raf said it there very well, no? Take those 3 steps together, particularly the auto borrowing, which, we discussed only 2 weeks ago, that, in the daytime, during the day, that borrowing lending is free of charge to anybody, and it's only at the end of the day that you kind of pay for the use of a bond from a lender, right? And so I think this is important that we communicate this even more clearer to the community. I have a question still for James. That the ERC has always thought initially when CCPs came to Europe, oh, this is going to solve all our settlement problems, right? But you suffer the same as we suffer as a CCP. So given that the G20 pushed the CCP so much, and it currently is only government bonds. But if you go down the curve of corporate bonds, high yield, and so, could CCPs be part of the solution, or would it still remain the same settlement efficiencies or deficiencies that we have now?
Yeah, so Gottfried, maybe I'll start by just kind of highlighting, I think, a couple of things on just the value that CCPs play in settlement efficiency today. So I think Sachin touched on it actually in the kind of the first question, but what we do as a matter of course for the transactions that we clear is we actually apply settlement netting. So that the gross transactions which come in, we net them all down on an individual ISIN basis by member on a particular day. That effectively applies kind of a 70% compression ratio. So we're actually already instructing into the market significantly less than what we clear. So we're already kind of adding that value of settlement efficiency into the market. We also already participate automatically in the auto partialing that we've spoken about, also in the auto shaping. So we already today shape into 50 millions shapes across the markets in which we clear. I think the question specifically referred to thinking about that kind of credit spectrum. Clearly, CCPs are there to manage risk primarily, to be able to manage risk in a default situation. So we need to consider incredibly carefully the types of securities in which we clear. And that's why today we clear kind of the full, certainly from an LCH perspective, the 14 government bond markets in which we do. Could a CCP potentially provide a role where it isn't clearing or assuming the risk on the transactions, but provides settlement or settlement netting services or settlement efficiency services for securities outside of the securities in which we clear? Possibly. I think it's something that we do sometimes hear some feedback on from our members, and we're kind of very willing to kind of listen to that feedback and also work with other industry providers to think what solutions might be possible. But I think we need to distinguish very carefully between the risk that the CCP assumes in the securities in which it clears and how the CCP can use it, potentially its technology, to provide settlement services to the market.
Alex, you have anything more on your sheet?
Well, if we have 2 more minutes, I would have just finished with Sachin asking you about the CSDR penalties, which will come in, of course, in 4 months. So we just created a work stream on our side as a substream of our CSDR working group that will be looking at cash penalties. Obviously, there has been a lot of work already on the AFMI side. So I just wanted to ask you briefly to tell us about industry readiness, or if there are any big stumbling blocks still that you see ahead of February on that side.
Sure, thank you, Alex. I'll try and keep this as brief as possible because I appreciate we are very near the end. So, yeah, I mean, relatively speaking, when it comes to settlement discipline regime, the buy-ins, as we all know, there's been a lot of advocacy around it, and we've talked about that before in a number of forums. And it's not just the market's not ready, but it's extremely difficult and suboptimal to implement in the current form. However, penalties, maybe not 100% perfect, but they're a lot more implementable, if that is a word, to be able to get that ready across the market. I would say that across the AFMI membership, based on the dialogue that we've had across our group and also sharing my own personal experiences, the penalty work has just been going on in the background, and we haven't really made that much noise about it in the industry, right? Yes, it's been a part of the advocacy around potentially, postponing and delaying the buy-in process for it to be revised in the future, but allowing the penalty still to go live in February 2022 to create some level of efficiency in the market, or create some discipline measures and fulfill the regulators' objectives in achieving that. So I would say it's been working in the background. However, it's probably come more to the forefront of the market now as we get closer, people realizing this is the element of the regulation, if anything, is most likely to go live next February if the advocacy goes through as planned. So I just feel that there's still some nuances that need to be addressed, which will happen over time as well. But one key element is the ability to recalibrate the penalties, which isn't being considered in the reg just yet. So I think there'll be further work to be done after February.
Okay, thanks, Sachin. I think that's a good conclusion of the panel. So thank you very much, everyone, especially the panelists, of course, for joining us. And with that, over to you, Gottfried, for the concluding remarks.
Yes, thank you to the panel. Thank you, Alex. It was a well-managed panel on a very good topic that we hope to solve very, very soon. So this is the end of the meeting. So here you see also the other updates that we have prepared for you, so you can read this afterwards. The latest repo survey is there as well, and it will be published in full next week, in the next few days. The next ERCC AGM will be held in Brussels on the 22nd of April next year, and it will be hosted by Euroclear. That's all I have to say now. Once again, I would like to thank Piro for sponsoring today's event. Have a good evening and see you in April. Thank you very much.